Hello, and we're back in doing Chapter 3, Practice Problem, and this is having to do with a WTI, Wells Technical Institute. I want to revisit what I have spoken about earlier with regard to accruals and deferrals, and one of the things that I want to get across is the fact that accruals and deferrals are the way to catch up revenues and expenses to match during the particular period of time in which they were earned or when they were incurred. Now, when I was back as a young accounting student, the thing that confused me was what accruals and deferrals meant, because I didn't necessarily have a professor who explained it exactly. So I came up with my own way of doing it. So I came up with a grid, and I put accruals here, and I put deferrals. Along the top I put action, and dollars. Okay, so accruals happen when you accrue something, that is, when you accrue revenue you earned or you accrue expenses you have incurred. And so in this case, no money has happened. You're simply accruing the revenues or the expenses. So an action occurs before the dollars. So where accruals and action meets, I'm going to put an X in that quadrant. Okay? Because accrual happens as an action before any money ever happened. Okay? Now deferrals would be your prepayment or your unearned revenue. In other words, someone has given you money, they gave you cash, they paid you up front, or you paid somebody up front, either direction, and the action has not happened yet. Okay? So as you're going through this, think about, did the dollar happen first? And if the dollars did happen first, that is, was there exchange of cash somewhere, that is a deferral before the action took place. Okay? So let me give you an example. Accrual would be your accrued salaries and wages. You put work in, you accrue the time, they owe you, they have not paid you yet. They don't pay until the end of the pay period. And usually they have to have a payroll run, so you don't get it immediately. You usually get it about a week later from the time you actually earned it. Okay? That is an accrual. A deferral is when somebody pays you up front to do work for them, and you have not done the work yet, but you have the cash in hand, but you haven't done the work. So in this case, the dollars has happened first before the action. That is a deferral. You're actually deferring the activity to a later time. That's what deferral implies, which would be your prepay insurance. You buy insurance and then they insure you, not before. They won't insure you and then have you pay for it. You got to pay for it up front and then they insure you. Okay? Alrighty, let's take a look now. We've got that straightened out. Over here we've got Wells Technical Institute, and Tristana Wells is the owner. They offer training courses, and they also offer courses where they ask for tuition. So there's going to be also a trial balance, unadjusted trial balance, that's attached to this. So let's take a look at this real quick. So here we have all of our assets up here at the top, followed by liabilities, accounts payable, salaries payable, unearned training fees. That is a liability because it's unearned yet. You had not earned it yet. And then we have the capital withdrawal account, followed by revenues and expenses. Now look, at the revenues, you had tuition fees and you had training fees. Those are two different types of fees. You're doing training classes and you're having a class where you charge tuition. Okay, two different things are happening here. So just a heads up that this is what's going to be coming up here. So you have to be very aware. You got two different types of revenue sources here. And then of course all the expenses that come after that. Okay, so let's start with the very first problem here. We've got these 8 transactions that we had to do. These are going to be our adjusting entries, and we're going to do journal entries for these first, and we're going to update the T accounts, the ledger accounts. So my first transaction, an analysis of WTI's insurance policy shows that $2,400 of coverage has expired. Now, if you were to take a look over here on the trial balance, what they mean by expired, check this out, folks. You have prepaid insurance right there showing up on the unadjusted trial balance, and it's for $12,000. So what we did is we had paid $12,000 up front, and at this point in time, $2,400 has already been used up. Okay, we had $12,000 we paid for up front, and $2,400 has been expired or used. So I'm going to move from prepaid insurance to an account called insurance expense. And if you're wondering what it's exactly called, take a look. Every time you are not sure, take a look at the trial balance. It tells you what the name of the account is, and the name of the account here is insurance expense. So a debit to insurance expense, and in fact every expense is a debit, okay? For $2,400, because that's what we used up of our insurance. And then the credit is going to go to prepaid insurance because it is a debit entry, so you had to do a credit to decrease it, to make it smaller. You had to do a credit to prepaid insurance. So I will indent this right here. And credit for $2,400. Okay? Next item. An inventory count shows that teaching supplies costing $2,800 are available at year end at 2015. Now here you got to be a little bit of a detective, okay? Here's our teaching supplies right here. It was at $8,000. So if I were to do a T account for this, folks, I'll just put it right here. If I did a T account for teaching supplies, I started out with a debit of $8,000. Okay, so that's my starting point, $8,000. It says here that inventory count shows that there are 28 available at year end. So 28 is going to be my ending balance right here, 2,800. Just like that. That's my ending balance. Now, I've got to do something over here, question mark. I'm going to have to do something over here to get from 8,000 to 2,800. What do? Well, the most logical thing is you do a credit entry, because you got to reduce 8,000 down to 2,800. So you take the difference between the two numbers, and that's going to be 5,200. Does that make sense to everybody in the room? So my journal entry is going to be for 5,200 because this is what I used up of office supplies. I used $5,200 worth of office supplies, and now I had to put it somewhere. So it was here at teaching supplies, and I got to put it someplace else. And if I go down here, we have a category called teaching supplies expense. That's our account. So for this one, I will do a debit to teaching supplies expense. For what I calculated of $5,200. And then the credit is going to go against teaching supplies because it is a debit and I have to do a credit to reduce it down. So teaching supplies is going to be a credit. $5,200. Okay. Number 3. Annual depreciation of equipment is $13,200. But if you look down here, annual depreciation on professional library is $7,200. Well, now wait just a doggone minute. Do we have equipment? Do we have professional library? Which is it? Which is it? Which is it? Which is it? So, look right here, folks. You have a professional library and you have equipment. You got two different sources of capital equipment here. Okay, professional library equipment. Both of them are depreciated. Okay, so they actually give you the number. $13,200 for the equipment, $7,200 for professional library. So we're going to do two different journal entries. And by the way, here's my accumulated depreciation, which should be a credit balance, as you see over here by this evidence. Now you're thinking, now wait just a doggone minute, isn't this in the assets section, and aren't assets supposed to be a debit? Isn't that the normal balance of an asset to be a debit? Well, we're not trying to pull the wool over anybody's eyes here. What's really happening here is this is a contra asset account. Accumulated depreciation is a contra asset account, meaning contrary to the normal balance of an asset. Okay? And so then I need to put that somewhere. And if I look down here, check it out, folks. Here we go. We got depreciation expense for professional library and equipment. And they're going to be debit entries. So for this, I'm going to do a debit to depreciation expense for equipment. That's for number 3. Because again, every expense is going to be a debit. Okay, so depreciation expense for equipment for $13,200. Okay, so we got that dollar amount right there, $13,200. And a credit to accumulated depreciation for equipment. $13,200. And since we did that, number 4 is going to be really simple because it's the exact same type of journal entry. I'm going to do a debit to depreciation expense for professional library. For $7,200. And then I'm going to do a credit to accumulated depreciation for professional library for $7,200. There. I took two birds out of the one stone. Isn't that great? I love it when a plan like that comes together, don't you? Alright.